So I think the mission is really urgent. I think it's urgent because there's a window of time that we have in order to be able to actually make this a mainstream platform that people can use. Like you can't go on for 20 years like this. You know what I mean? At some point, it's got to be commercial, and bills have to be paid for miners and all the services and businesses on it. So it's not like we can just take forever. It's definitely, there's a time limit on it. So that in that sense, we feel a lot of urgency. I think the timing is actually quite good right now. I think things have changed, perceptions have changed with respect to blockchain. It's becoming mainstream. There's big conferences where bankers are showing up and government officials are showing up, and it's sort of now being recognized as a real solution that everyone's exploring and people are budgeting for and things like that. So I think the timing is really good, and the urgency for us, the company, to be successful, I think is at its highest point right now. And I think going back a couple of years, I mean, we always felt it was super urgent. Like, there's been lots of late nights and a lot of stress trying to get it done. But at the same time, BSV, when everything else forked from BSV, let's say, there was still a bit of time that was needed to kind of prove it out. So I feel like in terms of mainstream adoption, it was unrealistic to think anything was going to come on the BSV platform that was significant for 2 to 3 years. But I think that time has passed now. I think it is robust. It is a serious platform. People are here for the long haul. And we just need to quickly get features done, deliver value, and then start to attract the real players, and then prove that it works stably, offers value, and then grow from there. And I think there's going to be a real rushing in the door coming in the next 2-3 years, where suddenly becomes clear what the winner is and how it works and how it offers value, and it won't even be a question in anyone's mind anymore. And then it will just be a matter of onboarding and integrating. So I think we're very close to that point. There's 2 or 3 instruments. So instrument types are the way we kind of phrase like the type of token it is, like the kind of financial instrument it is, or legal instrument. So there's 2 or 3 instruments that I think we need to get done before we can get the real big players on board with the most compelling use cases in terms of value for them, but also revenue for us. And those are on the deck. Like, we're going to be working on those over the next 6 months, and hopefully have them all done within the next 8 to 12 months is the plan. So we're very close to that mainstream part, and those instruments are really bonds and equity instruments, so debt instruments and equity instruments, and they're the most complex in terms of the codified terms and all the supporting features in terms of reporting and events and actions. So that's the big challenge. We kind of pushed that on to the later stage. We got the easy instruments done first to prove out what we were doing. But I think we're very, very close. I think it's still, once we get that initial launch doing, there's still improvements and extra features to be added for another 2-3 years on top of that. But we can start onboarding the big clients then and having them build around it. That's kind of the general idea, I think. I think we also just significantly further ahead than anyone else in the space. And of course, I would say that as a advocate of Tokenized and have someone who's interested in it. But if you really look closely at all the competing solutions that are even trying to play this game, like the Providence blockchain and the Figure team that kind of supports them for your company. Digital Assets isn't a company is doing with their DAML. And there's a whole bunch of other ones like Securities and Polymath and those types of companies. They're all, if you look at the feature set they have and the way they're approaching the problem, I think they're just years and years and years behind, particularly at the user experience side of things, and the features and functions, but also the performance and the underlying infrastructure as well, like Bitcoin SV's infrastructure versus their infrastructure in terms of scaling and resilience and things like that. So I think we're in a very comfortable position, but it's just, like I said, it is extremely urgent. We take it very seriously, and we're working really, really hard. So basically what our vision of smart contracts is a combination of script and codified terms blended in with like traditional English prose, like or whatever language legal prose that's human readable and human enforceable. So we blend it all together in a structured digital format that's kind of makes up the protocol. And so the codified terms and some of the mechanics that relate to script and transfers and all the kind of commercial events are ultimately going to form a master agreement at the protocol level that has legal pros on a jurisdiction and governing law basis to give every single element of it something that a human can read. So if there's a smart contract and it had some codified term in it that ultimately got disputed and it went to in front of a judge, they would be able to go in and find out exactly what it means precisely in the language they're accustomed to and the phrasing they're accustomed to. So it becomes sort of like a digital version of a real master agreement that has a lot of simplification, codification, and automation on the user experience, but it's still rigorously embedded into law. So the protocol is designed to be flexible and support all jurisdictions, and it would go beyond the Constitution. It would go into regulations like companies acts and state
rules. So you are
forming
a legal theory. You are forming legal precedent.
Well, we're taking legal precedent and automating it, simplifying it, structuring it, making it more standardized is probably a better way to think about it. But it's all encompassing is the key idea. So we're really bringing all the pieces together. So that's where the big value proposition starts to get unlocked, because then you can have a full life cycle of the contract be much more automated, much more insightful, and then you can generate reports that are typically done manually and with data silos with lots of errors in them and lots of uncertainty can all be automatically generated from a single source of truth. And when you take that whole picture into account, the value proposition, I believe, is a 10x over previous stuff in the private markets, and that doesn't even include the secondary trading component. So, of course, my opinion always seems biased when I'm posting these things because, obviously I have my own interests and protocol and business behind it. But I think it is a really key issue to raise, and it's something that does really impact businesses down the line. Because mostly it's a lot of people I find when they look at protocols, and this is not just STAS, there's lots of teams in the whole ecosystem, they're all focused very much on the very low level technical stuff, and they have some axioms and ideas or ideologies built into their thinking when they're evaluating the technical design. But I don't see many people really zooming out and kind of analyzing the whole system from a user experience point of view, which is, I think, what really separates us from everyone else. We started from the user experience at the beginning, and we worked our way back to the technology. And so we kind of thought like, well, what are the opportunities for this new vision of more digital finance and, real smart contracts, and, how scalable can we make this? How divisible can we make this? How cheap can we make this? How automated can we make this? Those are kind of questions that we started with. And then we kind of worked back and tried different designs, different approaches to kind of support the ultimate user experience and the best value proposition. Whereas, and then you come to very different conclusions about how to build the fundamental building blocks. And they kind of align much more with hard business and user experience constraints rather than just pure technical constraints or ideological constraints. So a lot of people I find have tried to like maximize decentralization or some other notion they have in their heads. And that may be a valid idea, but what is the effect? Like, does it matter? Does it actually add value to anyone? Does anyone really care about it, right? Because that's kind of the questions that we had, and ultimately our conclusions were not at all. And the advantages you get from a slightly different architecture is a lot more features, a lot more automation, a lot more compelling user experiences available to that design, and no one loses out on anything effectively. So to have like a really, like, if you think about like an exchange today that we're accustomed to for public securities, they're really deep order books. They move really quickly. There's a lot of activity, a lot of trading volume. And to deliver that kind of experience, I think you need a centralized version of it, is my current take on it. I think like a DEX, where you're essentially posting trade offers or buy orders or sell orders on chain that everyone can see and everyone can respond to, is very difficult technically. And I think it's probably legal at the moment. Like, I think you could probably get away with it because of the fundamental idea is really just two people negotiating with each other. There's not really a marketplace that has the traditional responsibilities of a marketplace and the unique sort of position that's ripe for abuse. But I think the actual performance and liquidity that you'll get is much less compelling than what you have on a traditional exchange. And traditional exchanges are pretty cheap, really, like when you think about the value they provide. So I think what we'll see is just really like traditional exchanges that already have huge customer bases, like the New York Stock Exchange, NASDAQ, etc., who will integrate with platforms like Tokenized, operating on smart contracting protocols to allow for their traditional matching engine, order book, services they have, to just then allow for the tokenized securities to work with those. And so really all they need is sort of a wallet layer and the platform layer to kind of add the extra insights and operations for the smart contracting elements. And what it does mean, though, is for those, even in public securities, you get a much more insightful, trustful contracting experience beyond just holding an instrument that's kind of, in today's world, fairly disconnected from the underlying operating agreements and administrative actions. It would just connect all that data up. So that's where I see the big value. But I actually don't see like the crypto exchanges of today lasting. I think that they'll get muscled out by bigger exchanges with more revenue and a better customer base already that will just add support for tokenized instruments and then extend that support out to private market securities that have the liquidity available to it, or the nature or the properties of a company or an instrument that can actually be traded like in that type of automated fashion.
So would I be a customer of, like, let's say Fidelity? And so Fidelity would use Tokenized kind of in the background?
Yeah, exactly. So kind of the tokenized platform or whoever hosts the contracts, like in aggregate, and the wallet elements can sort of plug into anywhere, right? So even traditional brokerages, online brokerages that have experiences that are pretty sophisticated and built up over 20 years, they can just add more features and optionality with all the tokenized smart contracting elements into it. And the same applies for like banking experiences. Same applies for kind of any financial service today. I can have this embedded underneath it. And then tokenized in combination with Bitcoin forms more like a clearing and settlement registry, central registry function, in addition to like the automation elements of the contracts. So it's like a very sophisticated clearing and settlement and record keeping layer. Yeah, I think that one's the tricky one for sure. The one that's one-to-one, that's not providing a yield,
right.
is, I think, very permissive. I think what we're all hoping for it to be can be done based on my interpretation of the laws. And that really has, I think the key insight is, and a lot of people ask, is why have gold tokens or gold money projects in the past failed? I think we're at a unique point in time where it's not only a technology element to it, but it's the crypto impetus that spurred on legislative change or regulation change. So MiCA, the marketing crypto assets in Europe, and Singapore seems permissive of it. Japan, they're the ones that are kind of front running it, and they're all mirroring each other for the most part. And they seem to be very permissive of the idea that peer-to-peer self-custody wallets can transact with these instruments without the traditional compliance, oversight, AML concerns. It's only when you do the on-ramp, off-ramp, or you go to an exchange or a service provider that you then have to do those processes, due diligence processes. So that really, in my view, is a key element to enable the money the way we all kind of envision it, as gold as money as we envision it. And it didn't exist, I think it only came into effect 2 months ago. So I think that's a really important part of it. And I think the US will follow as well. It's still gray in the US in a lot of ways. There's room to play, but I think that my guess is they'll follow, not only because of what I've seen, the bills going through and what discussions are having, but also the competitive elements to it, right? So the US doesn't want all the capital to flow over to Europe for successful projects like this, right? So they're going to want to compete with them on similar terms, so they're an attractive option that capital flows to them and has it in their banks and their businesses. There's also another thing that's interesting, I'll just add on to that, is there's a bill, I can't remember the name of it is, that's going through, that seems like it's getting a lot of support. I think it passed the House for changing the accredited investor, sophisticated investor rules. And they're looking at making it much more accessible to retail investors. And rather than being a wealth requirement to consider yourself an accredited investor, like you have to have X $1 million in the bank that doesn't include your house, or you have to be earning a certain amount of money per year, that type of thing. They're going to move it more towards competence. So you could take a test to prove your understanding of markets, financial instruments, and the risks. And if you can do that, you'll be able to invest. And there might be limits to it, I'm not sure. But it seems like, I think it passed almost unanimously across, like, bipartisan.
I haven't really looked into your identity oracle, but you think that's something that could kind of help facilitate that, like help onboard U.S. users in order to, like, actually become accredited investors, and then once they're registered with that oracle, then it's a lot easier to use the tokenized instruments.
So I think the main value prop of the identity oracle is really giving the issuer comfort that they're going to be contracting with people they want to contract with for a certain classification, right? So a company, like, it can be extremely consequential if you get bought up by a competitor or some type of entity that you don't want owning and influencing your company for political reasons, for competitive reasons, and also for compliance reasons. So there's a few areas of risk there that the identity oracle kind of enforces. So it gives them control over who can join, and they can set conditions about the type of investors they want to allow in and things like that. I think a lot of securities will use identity oracle like solutions, and there'll be various restrictions. Like, I don't think every company wants to have a crypto like experience with their stock trading all over the world and subject to potential market manipulation in dodgier jurisdictions and price fluctuations and all that kind of stuff, because it can cause a lot of noise for the company and a lot of sort of unexpected events. So I think that's kind of the key value prop there. And the oracle also just it improves the clarity and control while also making it really interoperable. So you can have, like, compliant registered securities be held at different user interfaces, like different wallets, where the wallet doesn't have to worry about all those compliance burdens, right? So they can just basically outsource that to the identity oracles. And so they just have, like, a yes, no request to say if it's compliant to who they're trading for, who the keys are, if they're registered, as opposed to having wallets all have to get their own licenses and do their own due diligence and make their own determinations as to who can get what. So I think that's kind of the key idea behind identity oracle. And I think it is not, again, like, I don't think the gold token that TroyMoney is doing should have that. In my view, it doesn't make as much sense there. But for a company, like a small private company, I think they're going to want that. And it's likely going to be for bigger ones, the transfer agent is going to operate that identity oracle or something similar to that, depending on which country you're in. The way I look at it is you really want to think about what the objective is of the issuer, let's say, or the holders. What are they trying to accomplish? And so what does a token accomplish for them? And so for cars, I actually think that titles of cars could be tokenized, and it's a beneficial way of doing it. So rather than like current registries, like car registries, which are like government agencies, having their own database of who owns what and having kind of like paper certificates or just sort of digital records is not very transparent, and a fairly complicated buying and selling process where you have to, like, go in and fill these forms out and things like that. I think all of that can be streamlined where you can go and literally transfer a token from your mobile wallet to the buyer at the same time they're paying you for the car. So you get an atomic swap record of it. The title's literally been transferred and all the identifying information has been accounted for and reported to the registry at the same time in a much more reliable way. So you're not as concerned about getting like driver's licenses out and proving who they are, who they say they are. Are they actually buying this car? And this is a contract that you can go and if there's any disputes, they can kind of resolve it accurately and not have fraud inject into the equation. So that's an example. I think it also applies to any kind of registry, like your company's houses, like your security registries, your property registry, like property title registries, even driver's licenses, trades licenses, medical licenses, certificates from universities. All of these kind of instruments are important. The timestamp is important. The overall, like, mechanics of sending, holding, receiving, accessing, the terms and conditions behind them, who's responsible, the administration of those contracts, potentially confiscations and freezes if there's, if someone's lost their keys and they want their engineering certificate or university certificate back, they can get it done with, like, an on-chain record. All of those fundamental ideas are sort of universal when it comes to, like, this. When you have an issuer and you have something of value and that's abstracted away as, like, a right to do something or an obligation to do something. So we see it sort of a universal concept, and they're always sort of really fundamentally contracts at the core. They tell you what this means, like what this instrument is, what your rights are, all that kind of stuff. So I hope that makes sense.
Yes. On the title of the car, that makes sense. But let's say, so I was watching Craig Wright on long time ago in a video, and he was doing the conference of what if we could tokenize, for example, a house and divide that house in 10,000 pieces, and when the market crashes, you just buy more pieces of the title of your house. Let's put it that way. Is that then now possible to tokenize?
Yeah, absolutely. So I wrote many papers on that, and I actually created a business plan initially for exactly that use case, thinking that would be the best use case to start off with Tokenized before I decided to go for a more generalized approach with how the platform is now. So the way you do it is you wrap a property. You could even do a car, but it's less compelling when you look at the fees and overheads associated with managing like a company or an entity around it. But you essentially take like a house, you put a company around it, you'd have like a director that manages the property and like lets it out to tenants or lives in it themselves. And then you have shares that represent fractional ownership in that house, and those shares can be traded. You can borrow if you want to leverage up on the property. All the shareholders kind of, their equity interest is counteracted by the debt they have on there, but that can have benefits in terms of investment thesis. So it's definitely doable. You can do that with art pieces and things like that. But the key insight is you always sort of need an entity to run it. You need like the tokens not to represent the physical unit. You need the tokens to represent interest in that unit, and there's a governance and administration set of rules around it, so that you know how. Because then otherwise, if people steal it, if something goes wrong, how are people compensated? What are the rules around that? I think those are sort of essential idea. So does that make sense?
Yes. Okay, so I could own a brick of 10,000 different houses all over the world. Let's put it this way.
Yeah, and I think it has really important implications, particularly around the changing environment that we have. So let's say like it's very like risky in a way for a family, let's say, to buy a house and have like 80% of the net worth wrapped up in a single house in a single location that may or may not be uninsurable or insurable. And if that insurable status may change over time as well, depending on weather events and how the world changes. So I think there's a big opportunity to have a business model where these companies are wrapped, or so these houses or properties are wrapped in a company or something similar, and they're owned in a sort of distributed manner by shareholders all over the world, like each owning a tiny sliver or brick, if you want to put it that way. And then because a person can have ownership rights to a degree, like kind of baked into how that company operates, they can still innovate, they can still renovate the house, they can never be kicked out, et cetera, et cetera. But if their house gets taken out by a wild bushfire, then it's only like 2% of the net worth. It's only on 2%. It's a small hit to them, and all the shareholders take that loss on the chin, but it's a relatively small adjustment to their portfolio. And you can recapitalize and you can fix the house and you can keep going on without insurance being involved. And so if you do that on a grand scale, it could be a much more efficient model that takes on more risk where it's needed without having insurance be involved and removing that cost from the whole structure. In addition to there's other benefits as well that are quite complicated, but I think that it could be a very compelling model.
You talk a lot about kind of complex financial instruments, and obviously you've done all the work in the contract structures for those, and I'm sure the insurance structures for those, and how all that works. And it totally makes sense that that's a big business driver to shoot for. I'm curious, are you also are you guys looking at kind of the more frivolous markets of loyalty points and things that aren't quite so structured and legal? Because like Garrett was on a space the other day, and what question came up about how do they get into vendors? How do they get people to start accepting Troy Gold? And that was kind of an idea that came up to me at that same time, is if you've got the technology rails in place, you've already got the connections, is more frivolous things, tack-ons of loyalty point systems or coupon systems or anything like that. Are those things that you guys are focusing on as well?
Yeah, absolutely. It's a great question. Actually, even right now with our current version that's released that everyone can download now, you can do discount coupons, you can do loyalty points, you can do event tickets. Vouchers are coming. We kind of haven't quite launched that one yet, but it's done. And then credit notes, which kind of can, vouchers and credit notes can be one or the other, but like basically gift cards, digital gift cards is the idea. And so our vision is that you really want it's actually the same vision that Elon Musk articulated with PayPal in the early days when it was, I think it was X.com at the time, but he wanted a single platform that has your entire financial life in all of its details and access to everything. And so that vision I share with him and really resonates with me. But I think you can't do it, or you couldn't do it until you get to the smart contract age, because so much of the value of and so much of the important details of your financial life is in the details of the contract, right? So even a loyalty agreement, a coupon agreement is always presented to you when you go to like a coffee store or you go to like McDonald's, presented to you in simple terms, like a little card or like a little app that has something that's got a nice graphic with it. But underneath that is consequential agreements that are very detailed, that lawyers have poured over, and they have to report on their books because they are liabilities, right? They do, they're prepaid instruments or they're an obligation on the issuer. So we think there's a huge opportunity to kind of structure everything so that every type of instrument, every type of financial interaction, every report and every filing can be done where it's a single wallet, or even better, because of blockchain, you can do this your entire financial life, but it can be accessible on any wallet in sort of real time, right? But you have everything there and you can sort of filter what's interesting to you. But then what it does is it's personally important to me because I freaking hate going to the grocery store and having to get out my special card to get my number just to get some bloody like loyalty points. That just means I'm missing out if I don't. You can have that built into the payment mechanism itself. So if you're paying for groceries, you can automatically get loyalty points without having to tell them anything. It's connected to the same payment instruction or payment action. And you can do an atomic swap. So it's recorded at the same time and it's sensible. So when you go back in time and you look at your records, you can see how many points you got for each payment, how that worked out. If any coupons are applicable to the checkout process, it will automatically apply them without you having to dig through or ask them and have them process it manually. And lots of other kind of events that can happen all in an atomic, streamlined fashion that will just reduce noise for everyone. Maybe people can go through the checkout counter faster if they want to, et cetera, et cetera. And then that'll apply also to online checkouts as well as physical. So it's a pretty big vision when you really kind of consider everything. And it's already supported on our platform. Although, as I've said in my previous talk with Charles, really to make it super compelling for most people, there's still a bit of work to be done in terms of like point of sale, checkout experiences and things like that to kind of make it really useful. Yeah, sure. So there's 2 points to that. So the first is like the loyalty points might seem fairly trivial to some people, like who hold a small amount, or it's just not that important to their life. They don't really like think about it. And so security is perceived to be lower. But when you think about it from the issuer's perspective, like Air Miles is a huge loyalty program, right? I think there's probably billions and billions of dollars tied up in it. So from an issuer's perspective, it's extremely consequential, the security, right? So that like,
yeah, I'm talking more like local coffee shop or.
Sure, yeah. Okay, well, so like I actually know what most of the local coffee shops pay in terms of like their little loyalty program systems they have now that are quite cumbersome, but they're on the order of like $50 a month. And our approach to that for a loyalty program contract is, I think it's about that price, maybe a little bit cheaper. And then on the per use basis, it's like inconsequentially, like if it's 1,000 tokens issued a month, we're talking like 5 cents of fees, less than that kind of thing. So we designed it so it scales. Our pricing is very kind of attuned to how many tokens are held by customers, therefore how much value is being held by customers and risk, and then also how many actions and stuff. So when you have the difference between like an Air Miles program and like a small coffee shop, the one pricing model I think is compelling for both, and it scales with use and risk. So it's actually, we have a pricing page on our tokenized.com. If you go to platform and then go to the bottom, and it has all those details, and it has a calculator for you to like calculate for different use cases and sizes. But we think it's compelling. We may have to adjust little things as we go and we get feedback and see how things play out. But I think it's a good starting point. I just did a lot of reading. like as a child and growing up, like on economics and philosophy and business, finance. So just tons of reading. And it was in, I think I was 16 or 17, I got into Austrian economics and got stuck into it. Spent 3 years just working through all the ideas and comparing it to the other like schools of thought, let's say. And I consider myself like a soft Austrian, as I kind of almost see it as like capitalism as like a like to kind of go away from Austrian kind of thinking, like those economic laws that are pretty simplified and core to how people operate and how they act. You have to use sort of like energy or force to force something to change from that. That's kind of like the default state is how I look at it. And so I do think regulators or government agencies can and should change how things operate in the economy, like interfere with it to some degree, but they have to be very careful about the calculation in terms of what are the benefits versus the cost. Because anytime you use energy to change how the market would naturally operate, it costs a lot to do. You're kind of forcing against nature almost. It's kind of an underlying principle that I have. But I understand there's like geopolitical elements to it, right? Like there's advantages to nations that do subsidies and interventions that can, in the short term, benefit their economy at the expense of others that don't sort of take those actions. And then on the long term, those benefits can compound. So there's a competitive element to it, which I think is often not appreciated as much by the Austrian school. So that's why I wouldn't say I'm as strict as, does that make sense?
Yeah, so human action, but not so much man, economy, and state.
Yeah, I'd say so. Yeah. Yeah, so I'll just give you my honest answer. It might ruffle some feathers, but I think that one token protocol will reign supreme. I think it's too complex to have more than one. Like I think about if you look at like as a analogy, there's a few financial messaging standards across the world, but they're not even that complex. Like ISO 20022 is not that complex really when you look at the details, and it took like 12, 15 years. I don't think every bank, I think something like 80% penetration has adopted that standard today after 15 years. I can't remember, it's being published and starting to adopt. So when you go to like a smart contract Bitcoin based financial system, the complexity jumps up significantly. Like we're talking beyond 10x, I'd say, in terms of a traditional financial messaging standard on a traditional network to this future that we're going to. Just a lot more in the scope. And that's where the value is, in my opinion. So I think one will win. It's certainly possible that some use cases we'll certainly find just it's easier and more, for like one-sat ordinals or the ordinals protocol or STAS, or even just like not even that, like a MetaNet kind of version for some things, like might just be a little bit more efficient and appropriate. And even within our protocol, we think of certain types of, like I guess ownership records, like a copyright itself versus a copyright license. I think is probably better done just by a simple one-off transaction payload between two parties with a signature on the side, no agent involved, no other complexities, because it's not really like an instrument. It's not tradable. There's no terms that you can really enforce that are codified or machine readable to really a great degree. So I think those kind of things might, have a role, and I think the differences are fairly trivial between them when it comes down to the protocols. But that's my honest opinion. I think one will win. I think the interoperability is such an essential part of this that it's impossible to have more than one, but we'll see who does win. Like there's a lot of good work being done by the competitors. I think like it's not all doom and gloom like I say it is sometimes, or when I present my points. Like there's a lot of innovation and creativity and things. I like pay attention to them. Like I go see what they're doing in the wallet, and I've learned and been inspired by many different parties in the ecosystem, and we continue to refine our vision and improve. But I do think one's going to win, just like I think there's only room for one Bitcoin or one blockchain. It's going to win as well. It's just too complex for everyone to try and interoperate with more than one. Yeah, sounds good. We see like the kind of tagline that a lot of people have shared that we agree with is kind of the idea of everything being tokenized. So the whole global markets being on this new tokenized standard with every instrument represented and every legal action, financial event being represented and standardized so everyone can interoperate with it in a more software enhanced way and more automated way with better trust at the core layer. So that the main target that we're going after is the private markets, which is like a really broad concept, but it just sort of means like everything financial or commercial in nature that isn't the public securities that are traded like the Apple stocks and Tesla stocks of the world, right? So public security or registered security is really like a special class of company that goes through a registration process where the regulators do a bunch of due diligence on it and compliance checks and enforce a bunch of rules around how that company operates. And then once they're satisfied the company meets the rigorous standards they have, they can list it publicly and retail investors can trade it as well as sophisticated investors and often globally as well. So those are quite digitized, those markets already have been for a long time. Like the process of dematerialization started in the 80s, I believe. But the private markets have basically remained extremely fragmented, extremely bespoke. Every agreement is a little different than the other ones, both in terms of how it's phrased and structured, but also the terms and conditions. But when you drill down and you really think about it in a first principles way, like the private market agreements there's foundational ideas that are common to all of them. And they actually don't differ as much as a lot of people think in terms of the effect, like the illegal effect and what the parties want out of the agreement and the protections they want and the ways that bad outcomes or disputes are resolved. So these are the patterns that we kind of really have focused on and are looking to standardize around. So we want the contracts that we're building these private markets to be more like a public market experience where you've got great software that lets you form a contract, negotiate, review and edit like in the drafting process with different parties, sign it, and then administer it over the life cycle in like a much more what we expect in a traditional like 21st century SaaS platform that's online. We think that is the future for the private markets. It hasn't been done to date. I see it as the last or one of the last great digital transformations in business record keeping. And I don't think it has been done to date because it's super hard. There's a lot of complexity. Like you really got a big scope of work. If you compare it to like the dematerialization of public securities, there's a fairly narrow list of public securities and ways they can operate and terms and conditions that you can have. Same with like CRM and like email and like all these other things, right? And even some of those are pretty complex too. I just think that the private markets and going from the contract level upwards is just a much bigger challenge, and that's kind of one of the reasons why it's been left to last until now. And blockchain really serves as an impetus to do it. So the blockchain component adds value, but the digital transformation of contracts is sort of a separate piece that doesn't strictly need to rely on blockchain, but it is enhanced by blockchain in a big way, and it is an impetus for it in our view that kind of allows it to be a standard global mainstream kind of solution. Yeah, that's kind of my thinking there, but it's an absolutely enormous market. Like the private markets are far bigger than the public markets. There's way more activity. There's way more complexity. There's way more administrative pain. There's way more screw ups and a lot more legal disputes and costs around it. So the opportunity is enormous, and the value to these people once the platform has all these features is a lot more valuable than it was for say like a dematerialization of public securities in our view. Yeah, absolutely. So it really comes down to like I think most software really is all about efficiency, right? So it's an extension of your mind. It's a communication tool and information and knowledge sharing and management tool. And so all software really at the heart of it enables you to do things more efficiently, right? Like you could still send a letter to someone before email, right? You could still do it, but it just took a lot more and it cost a lot more and the latency was awful. So I think that the smart contracts on our platform is really about driving significant efficiencies for key processes that need to be done, that need to be shared, that need to be approved, and kind of collaboratively worked on. So we think that is a key part, but the efficiency gain is significant. That's why I think it's a 10x improvement over existing solutions, is because the administration of a life cycle is very expensive. So it's expensive in the sense that it's time consuming for the people involved. It's complex. It takes a long time to get your head around all the details and the risks. You have to involve expensive lawyers that are very expensive, and they put lots of hours into it, and the deal may not support necessarily like 30 hours from a lawyer, but you may get that complex. And humans are also very tricky when you get into negotiations, right? So I think structuring this can also improve the negotiation process. It can simplify it and streamline it a lot more. It can get to the sticky parts a lot quicker. And then the reporting, all the downstream stuff is really time consuming and filled with errors. Like, so here's a key stat that I thought was shocking is cap tables. Something like 80% of cap tables have a consequential error in them. So meaning someone is either losing out or someone else is gaining unfairly. And that, think about the adrenaline and the stress that like a founder, like I can speak from experience, you go through trying to make this cap table absolutely perfect, all the formulas perfect, because you're trying to pitch to investors or putting their money into it, and you're trying to make sure everyone's not affected, there's no consequences down the line. So you put a lot of effort into it, and still with that kind of importance, 80% are done wrong. It's pretty shocking to me. And you think about all the other reports, the corporate records, the registers, debt registers, payment schedules, all that super hard work, and usually gets delegated to like professionals that do it, and they do it on spreadsheets, and they dig through contracts, and they manually have to constantly stay on top of everything at great expense. And then there's just a trust element to it too, right? So even our company, we don't have it tokenized yet, but I have to regularly send cap tables out to investors just to make sure everyone's on the same page, right? And there's different versions, and they'll look at the wrong version. They'll find a mistake, they'll email, we'll talk about it, oh, you have the wrong version, send it to them. You know, when you have an update to the contract, if you go through and update all those dependent registers and reports, and then send it all out again, and you get stuck in emails, not everyone files things nicely, like correctly. And so there's just a tremendous amount of trust that can be built and simplicity that can be built into it that removes complexity, removes steps, removes mistakes. And when you aggregate it all together, it's just a very, very compelling value prop in our view.
And all that data can just be pulled from the blockchain and compiled into a table very easily because it's all correct. It's all immutable. It's all there. It's all been done for you. So by the time you get your cap table or you pull the data of how many tokens are out or how many tokens of each class of stock are out, you just can very easily get your cap table perfect.
Exactly. And eventually automatically. So that's where like,
yeah.
When you have the scope of the protocol that we do and you approach the problem like we can, you can start to integrate or associate payment functions like distributions and subscriptions into, like, tie it to the contract in a way that software can make sense of. So that means that the actual cap tables can be automatically filled out, which can't be done today. So even the best cap table management solutions, you're pretty much left to like some employees going through and pulling details out of the resolutions and agreements and sticking the things in manually. And then you really just got a fancy spreadsheet at that point.
And the cost of cap table software is like, you can, for a company, can get to be like $500 to $1,000 to $1,500 a month for some sophisticated cap table management software, where if it's on the blockchain and it's part of the system, it's much, much more economical and a big saving for a company by going through the protocol.
Yeah, and it also de-risks like vendor lock-in as well, and it makes it more universal. So if you have like, let's say China and America or Russia and America aren't super friendly at the moment, and they want to trust the record keeping that they have that partially interacts with different companies involved in different jurisdictions, potentially contentious, having on the blockchain layer sort of like removes the political risk from those records, removes the organizational risk from those records, right? So in a catastrophic event, losing commercial records is super consequential. It can be impossible to fix, right? And people can be out millions or billions potentially. So these records are so consequential to the fabric of society. If you can kind of de-risk it and make it so that no one controls it and no one has final say, or they can strong arm people over it or misrepresent things, it just has like a built-in adoption incentive, I think, that can really be global. Yeah, correct. And I think the key insight there, and this also applies to secondary trading, is the terms and conditions are consequential to the actual ability to affect the trade. So in the public markets, it's kind of standardized that sort of anyone that's been registered with a broker can buy and sell public securities without really much discretion. And the terms and conditions of that contract underlying it are shaped to support that kind of liquidity and that kind of way of being traded. But in the private markets, that's not the case. And often, like, the directors of the company will hold the right to approve a transferee, right? and there's other terms and conditions that may other shareholders might have the right to buy a percentage of that deal or have first dibs on it, essentially. So you have all these sort of terms that you have to dig into, and you have a process you have to go through in order to be able to affect that secondary transfer. And when you've got codified smart contracts and all the software supporting it, you can trigger, like say you want to do that, you can trigger all the quick sequence of events that goes to other shareholders passing, directors approving, and then affecting the trade much quicker in a standardized way. And you can know what you need to do well ahead of time in a very simple way. And that just strips out, I think it will strip out weeks and weeks of time. That typically takes, like, it can take months sometimes for these kind of transactions. I think it can strip out weeks, if not months, out of the process, and can just make the cognitive burden an order of magnitude less. Like, everyone knows exactly what's going on, when, who did what, why they did it. It's essential, and that's what kind of software again is all about. And we're just applying those principles to this problem set.
And I guess, unless somebody else has another question, I want to go through one more thing. The debt, issuing a bond on Tokenized. I'm about to issue a big bond offering on Tokenized for a company that I have. And forgetting about the tradability or the transferability or the future moving it around and trading it, but just to be able to distribute the coupon, the monthly coupon. Most bonds will pay quarterly, some will pay annually, some dividends. But when you've got a bond on a blockchain, you can literally pay your coupon monthly, and the amount of effort to do distributions through a tokenized platform is like almost instant, especially when we have the stable coins, or if I want to pay my coupon in gold token, or I want to pay my coupon in BSV, or I want to pay my coupon in a stable coin, the distribution to the wallets is just so much easier, correct?
Oh, worlds apart. And you'll actually find in a lot of private bond placements, you have paying agents, like professional lawyers essentially, or professional advisors, doing that process on behalf of the bond issuer, because it's such a pain in the backside, and it's so consequential legally to make sure that you pay on time the right amount. There's calculation agents, and it's actually quite complex. And you think about, those guys are probably charging minimum $200 an hour. Probably takes them 4 or 5 hours. They're probably doing it once a month. So the costs just really start to add up. And then you got like the international aspect of it, navigating through the different intermediary banks and Swift networks, and the cost there, and the time delays and the fees that get taken out of it. Our vision and what our platform is geared up to do is essentially like remind you that you need to make the payment and who you need to make the payment to. Click a button, done, and you get charged like 0.1% to do it. And it can be to a much broader set of counterparties than what you'd commonly be willing to do in the way things are done now. So you could have, rather than larger bond sizes, like $1 million each, let's say, and you issue, say, 10 of them for a $10 million raise, you might be able to break that up into 1,000 pieces or 10,000 pieces and service those instruments, like pay the distributions out regularly for fractions of a penny, and no time on your part, in a way that they can instantly see it's there. You can see it's been paid. There's no disputes there. So then it becomes feasible to manage it. And that's really, like, when you really have a much more efficient administrative layer, you can start to push the boundaries of how complex these agreements effectively are, in terms of how many counterparties are involved, what the rights and duties are. And so that really opens up commercial value in our view.
Yeah, that's a big advantage for a company that's issuing bonds. Not, we talked about moving a bond from trading a bond, trading an alternative investment bond or an alternative investment debt is cut down tremendously, because you can do almost got a 3-party swap, or trusted swap. One guy's selling, one guy's buying, one guy's paying money. But the distribution, the management of the asset, the management of the operations through the blockchain become tremendously competitive with current standards. I've been building out TroyMoney for the last 2 months with our combined development teams, and working with the tokenized protocol, working with James's knowledge of how real world assets are supposed to function, the way I've known them to function for 38 years. and having a guy like James running a company with a protocol that actually has the same thought patterns in the way a real world asset is supposed to operate versus the way some tech developers, some other protocols think it should operate is night and day. And I think there's a consensus when you get real world operators and real world issuers, as you talk about the growth of tokenized, when we bring in real world issuers, most real world issuers don't operate the way the book says. They don't operate the way that technical developers say they should operate. And so I think the flexibility you put into the tokenized protocol allows guys like me, and there'll be thousands of us, and there'll be hundreds of thousands of us, to actually come to you and almost get a custom solution without being a custom solution. Talk a little bit about your thought process behind that, your experience behind that, and how you came up with this protocol.
Yeah, so yeah, appreciate the kind words and the recognition. So there's it probably came from like a little bit of a selfish perspective, almost like in the like I just hate inefficient things. I get so frustrated with things that take too long or complicated. It's just like a personality thing. And so when I say designing from a user experience point of view, like yes, I went and understood our prospective customers and kind of understood what they're thinking and why they're doing the things they do and what the compliance needs are. But also from my own perspective, I was like, how can I make this super, super compelling? Like, how do I remove all the annoyances in life that are associated with this? How do I make investing more accessible? How do I make it more understandable? And so that's really like a UX perspective. And I guarantee if you talk to the other guys on the Tokenized team that are putting huge amounts of value and contributing massively in terms of the innovation that we're doing and this experience, they have similar views. Like they don't like dealing with lawyers and accountants and all the paperwork and the headaches that come with it. And I guarantee it's kind of motivating and driving a lot of their sort of judgments on it. But it's a user experience focus that we have, right? We want to maximize utility. We want to create the best user experience, and everything else is subservient to that goal. And that's why we're so flexible in our thinking about blockchain and smart contracts and technologies and protocols. Is like we just want to make the user experience phenomenal, and the user experience extends to more than just clicking in insights and kind of like how things are presented in the UI. It also extends to the security elements. It extends to the record keeping, like what the data structures look like and how you can understand the contract quickly and gain insights from it. And that's just the focus. Everything just revolves around that. And that was in our white paper at the very beginning. It was just who I am and thinking about the problem. So we had like in our philosophy introduction, it was like utility. This is the heart of what we're doing here. There's no point in doing any of this unless it's super useful, and we want to maximize the usefulness to the absolute extremes that we can do. And there are opportunities here. So blockchain does provide opportunities to improve how useful this stuff can be in a big, big way. And we want to just extract every little bit of value out of it that we can for our customers. So yeah, there's a couple of reasons for it. So one I was kind of referring to or spoke about earlier is the complexity of it. So to support, so we see like exchanges and a lot of businesses today support many different networks and coins, but they're all super basic in what they do. They basically just have the send and receive functions, and like a lot of them are pretty awful even at that. But that's all they've managed to do to even with billions and billions of being pumped into these teams and projects. The stage, not only Bitcoin with like its UTXO model and the nature of it being public and the privacy concerns that come with it, but also going to the next step or two, which we're doing, which is the contracts element and like sophisticated instruments, sophisticated actions, is so complex. I can't stress that enough. That you can't really, the world cannot support more than one on that basis alone. It's too expensive for all the financial players and companies in the world to adopt more than one protocol when you get anything further past the basic send and receives of a crypto instrument. So that's one element to it. The other element to it is there's three elements total. The second one is there's economies of scale at play here. So the network, in terms of its services, its mining operations, and its general value overall, is strengthened significantly with economies of scale. So you can go cheaper, faster, better by having one network than you can with having many networks. It's just fundamentally how it's going to go. And so there's that point of it as well. And one chain can do it all. You only need one chain for that reason. Like if it can do it all, and there's no organizational risk, which proof of work allows for, the design is elegant in that sense. There's no political risk. There's no jurisdictional risk. Then you don't need more than one. And the economies of scale make the value proposition stronger by having one. And then the third point is a single source of truth. As soon as you have multiple blockchains that pretend to be single source of truth, you will have conflicts. You'll have time-stamping conflicts, and you'll have double records, and you'll have double entries. You'll have multiple sets of books problems that emerge, which is a massive part of the value proposition. So it's like it doesn't even make sense on that level. The very reason for having a blockchain is to have a single source of truth that is irrefutable, and all the records tie into each other, where you have like every commercial event is sort of linked to the counterparty involved, which is then linked to the other counterparty involved. So it's this big web of interactions and connectivity that's all immutably timestamped. As soon as you have more than one blockchain, that becomes invalid, and then you end up with bigger court disputes, more uncertainty, in a very systemic way. So those are my views, the three reasons. I also think that there's more to it, but I think those are the main points. Yeah, great question. I get this concern a lot. I think generally there's basically the key idea with our protocol is that every single record of consequence is stored on chain in a sequenced manner. So if you want to request a transfer, the actual request action that gets published to the blockchain has no involvement from the smart contract agent, which is operating basically the administrative agent that operates the contract. So you can publish in a permissionless manner the intention and the authorized action to actually transfer those tokens, and the actual administrative agent, the smart contract agent, is really performing a function that is free of discretion. It's deterministic. There's no sort of like, if you can see the blockchain and the subsequent records, how it has to respond to conform to the protocol. Any mistakes that the smart contract agent were to make is invalid. It's not part of the protocol. It's not considered a legal action, and no other wallet, no other service would even recognize it as being valid. It would just look like malformed, essentially. So there's really no risk, and anyone can independently verify the record keeping at any time. So you can just go and monitor the blockchain. You can see every record in sequence that the blockchain is managing, or the smart contract agent is managing in real time, and see for yourself that it's all valid and according to the protocol. So the risk is, in my view, non-existent. The worst part would be like an interruption of service, which can be mitigated evenly. And effectively, when the smart contract agent comes back online, it just corrects the record and catches back up, essentially. So that's kind of the key part. You can, with the smart contract agent, you can distribute it. So you can use threshold signatures and have multiple parties, like multiple infrastructure providers, multiple companies operating them, where you have like a 1 of 3 or 2 of 3 where they're voting on it, and they're separate and distinct parties that have no interest in it. So that's a way of kind of making it more resilient if that's a concern that you have. But also the key part is like an issuer, like the issuer wants their contracts participants or their counterparties to trade, right? That's the purpose of it. Like it adds value to their company. They want this thing to go through. They want the administrative functions to be carried out. If they were to abuse that position for whatever reason, then they got instant recourse. Like the record of them abusing it is on chain. It's not recognized by the protocol, so no one will take it seriously. And they go to jail, and there's a pretty compelling record that they did the wrong thing. So the incentives just don't align with any of that being meaningful. The important part, it's almost like, like between wallets, right? Before you actually publish, let's say an atomic swap, the actual negotiation and signing process does not happen on chain. It's off chain, right? But both of those parties want that transaction to go through. Once they sign it, they're wanting to do that, they're spending the time to do it. It doesn't need to be on blockchain. Only the final action needs to be. And so that same kind of principle of incentives and mechanics applies to the smart contract agent in our view. And we think by doing that and recognizing that fundamental reality, you can make a much more useful, much more efficient and lower cost system that does a lot more versus trying to do it all on chain. So even if there was even if Ethereum could scale, let's say, and it didn't have the gas model and it was improved, so you remove some of the nonsense in it and it's conceptually better, I wouldn't want the miners doing all of that extra work and that contract state management, because there's no value add to forcing all the miners to verify and validate those things independently of each other and come to a consensus. You don't need that. All you need is a timestamp. So you just need a consensus about the timestamp and the authorization, who did what when, and who was first or not. But all that matters is the timestamping function. So like that's kind of my thinking. So if Ethereum figured out their scaling or whatever, and they improved the network and their services and all that, I still wouldn't want to do it that way. I still think we can outcompete them with a better value prop that doesn't affect negatively anyone, essentially. Does that make sense?
Yeah, very good points. I think you have many methods to mitigate this issue and challenging.
Yeah, thank you. Yeah, we certainly have thought a lot about it for sure, and that we feel ready to serve billion-dollar companies and everything like that. And I don't think there's gonna be any issues. And lawyers have looked at it and they're really happy with how it operates. So hopefully the customers will agree.
Yeah, thanks.
Why did I choose BSV and Tokenized for TroyMoney, stablecoins, and my other projects? Why did I choose that?
So my impression is just basically that we resonated really well in terms of what we're trying to achieve here, and the quality of the product was a big part, and also just the needs that you have, things that are like fundamental to you getting this done, were done in a compelling way, and the competitors didn't really have anywhere near the solution that we had. I think was a big part. And then philosophically, I think we really aligned. I think the kind of core value prop ideas and the utility elements, what we're trying to achieve here, why we're doing it, is we aligned very quickly. It was within a couple of calls I could tell that I was speaking to someone that was very like-minded, and my spirit animal type element to it.
And yeah, it's very fair. And as an issuer, you know, I've been through the Ethereum nightmares. I've been through the Polymesh nightmares. I've been through the Stellar nightmares on the other side of the chain, trying to find some protocol, something that worked. And those chains, to be honest with you, were never built for smart contracts or security tokens, even though they say, or they try to say, they have smart contract capability. They were never built for what we're talking about today. They were built for, you know, trading coins, trading a simple ERC20 tokens back and forth with no value. But I think that what you've done with the protocol, you've taken a blockchain, a public blockchain, and your protocol builds in the very essential things with one smart contract that some of these other chains took. I mean, just to be in compliance with the regulations, it took 6 or 7 smart contracts to achieve a compliant instrument that could trade in America, for instance. And you've done it all in one smart contract and somebody gave me this quote, and I steal it all the time: on the fastest horse in the race. BSV is the fastest horse in the race, and if you've got that, not only fastest horse in the race, but the most economic horse in the race, I think you've got something that's very special, and everybody listening here today should be very happy that this is running on BSV. And, you know, a lot of people here have BSV holdings, and I think that more real world players that can build on Tokenized, and more issuers that come to Tokenized, somewhere down the line that will bring more intrinsic value to the BSV coin, and that will be the end game winner for everybody holding BSV. That it's actually got a use case that is long term and very sustainable.
Yeah, I just want to build on that too, because I think it's some good points. But in my view, like it's not just the technical elements of BSV and like the philosophy behind it, but it's also the people. So when I look at most of the crypto industry and the supporters of their networks, I just don't think they have as good judgment about what this thing needs to be, where the value is, how to build. And what I see in the BSV community is a lot of very talented people that have very realistic viewpoints on how the world works and why we're doing this. And so that, and I haven't seen a collection anywhere else. And then in addition to that, deep conviction, right? So it doesn't take long to go and look at the other networks and really scratch beneath the surface to kind of evaluate how much people really believe in what they're doing, and are they really building like they care, and are they putting the extra effort in and staying the extra hours, work on the weekend to get the thing done? Like, do they believe the companies be successful long term? I suggest not. They may say something differently publicly, but if you really look at what they're doing and where their heart is, it's not the case. And BSV, I see a lot of extremely passionate people that are extremely motivated, that really believe in it, and are building like this is going to be mainstream tooling. So I think that's a big, big part of it.
You said a key word, passion. You can't buy passion. You
Definitely
either
not.
have it or you don't. You either
Agreed.
have it or you don't. And I do see that. I've not been in the BSV community very long, but I see everybody. I talk to a lot of people, and everybody that's working on stuff, and even people that aren't working on stuff that are just in the community. There's a lot of passion for BSV solutions, BSV situations. So that's very. You're right on the mark there. The other chains are just like, they're just doing it for the money. They're not really much passion there.
We have within our protocol the ability to make changes that are append only. So you see the correction record as well as the original erroneous record, let's say. But we have the ability to amend contracts. We have the ability to freeze and confiscate and unfreeze tokens at the discretion of the issuer if the contract has been configured to allow them to do that. The same applies for delegated authorities. If that is the business model or the approach that needs to be taken for compliance reasons or business reasons, they can delegate the ability to freeze, confiscate, or unfreeze to a regulated entity, let's say, a transfer agent or broker to perform those functions. And then we also have other ways of correcting issues if they arise. So we've kind of thought about every possibility that could happen. And essentially the key idea is that we can correct the record to preserve the graph and preserve service so that everything can keep operating and you don't need to reissue a contract. Because at the end of the day, some mistakes or things that need to be changed for even like a court order or like a fraudulent act by someone, ultimately, on any blockchain, you can change it, you can fix it. But in those cases, you typically require off-chain records to freeze. Say like, okay, that's a blacklisted coin now. We're going to reissue a new one. Everyone ignore that one now. So you've got kind of an off-chain partial record of the database that augments it, or you have you just reissue a whole new contract. So you basically say, everyone ignore that contract. It no longer is valid. We have to reissue a new one here. This is the real one. We'll airdrop everyone that previously held it their coins and correct the record, which then you lose the graph, you lose the nice record keeping. It becomes a lot more complex. So you can sort of do on any blockchain, but there's just much better approaches like we've taken than other approaches. And it's just understanding the realities of business and what is actually needed by issuers and property rights enforcement by courts and legal systems. So once you kind of appreciate all that, understand its importance, you can improve it. You can make it easier. You can make those records immutable and signed by the authorities. So it's a more transparent, more accountable system. There's no more black boxes, but it allows for property rights to be enforced and recognized accurately rather than having to augment the chain with off-chain, non-immutable, non-single source of truth records that can be changed and manipulated. So I think that's kind of a key point. Sorry, do you mind explaining what a trustee bond or like a surety bond specifically means in this context? Like what is it accomplishing?
Yeah.
Who's issuing it?
So once a certificate of trust is just drafted by the grantor, and you have a successor trustee, a co-trustee, and then you have benefactors who are reaping the benefits, and all of them is decided by the grantor. In any case, if the trustee is not doing the duties set forth by the grantor, the settler, the beneficiaries can go up to an arbitrator and request, or in this case, they have differed in the equitable interest of the contracts which are not followed, right? So the trustee bond is like a way to go to a court and then just them being an arbitrator and paying the damages, right? The claims are made by the beneficiaries for the bond, and it'll be like like Javier, like I don't know how you would explain it. Like this is how I think it is, but in terms of having this instrument on a blockchain, how does this work out? In terms of more streamlined function between the court, right, as an arbitrator, as a probate court, what can they do on their end? How can we make this service more streamlined for them to see the chain of trust, all of that, like can we revoke access to it, all of that.
Right. So essentially, you're saying if there's a dispute between the beneficiaries and the trustee, that there's an arbitrator that steps in the middle and resolves the dispute efficiently. The question is, how can you improve that relationship? So one thing that we have not actually visible in our app right now, but it's in the works, is codified dispute resolution, because it's that same core problem exists in business too, right? Arbitrators are preferred dispute resolution mechanism over going to the courts because it just costs a lot less for everyone and it can be resolved a lot more effectively. So you can agree as part of the initial contract to use a particular arbitrator or a set of arbitrators, or the rules around selecting one. And you can actually, if you wanted to, you could probably even make for a trust. You could probably make the identity oracle and authority oracle the arbitrator, so they have the power to go in and fix anything that needs to be fixed without doing anything. Although I don't think that's that meaningful, because it's not that so much the trust records that are in contention. It would be like how the assets within the trust are managed, right, or how they're just distributed or whatever. So it'd probably just fall upon normal arbitration processes, but by selecting them with a codified term and making that super clear in the contract process, it can be improved, I believe. We have a lot of ideas there that haven't been fully fleshed out, but we definitely think that's a major part of the contract that should be codified. When it comes to the surety bond, is a surety bond kind of like almost like someone financing a lawsuit, where they take on the financing risk of the lawsuit and they assess the probability of success and they get the proceeds in percentage, something along those lines? Is that a fair way to describe it, or am I missing the boat here?
Well, that's what I think. So, Javier is more, he's listening to the call. He's more well accustomed to answer that question. Hopefully he can just jump on the call and just, speak about it a little bit. I think it's more of like a if there's a dispute happening, right, and there's like a set bond that's decided by the court and by the certificate of trust, then that contract is accepted, and then the arbitrator, all he has to do is just follow the rules and give out the funds, right? So
is bonds like insurance,
I think
kind
it's
of a little bit of insurance on
it
for disputes?
yeah, these are like insurance bonds, for the disputes, right? For the assets and the properties, different asset classes, right? If they're not following the the rules laid out within the contract statements, so they would have to
Right. So
it's like a form of non-repudiation, right? How do you figure that out? Like those are the questions that are like kind of my kind of thinking,
So it's
like,
kind of like a rental bond. Like if you rent a property, you have to put some money up. So if the trustee is administering a trust, they or someone on their behalf puts up money in the case of issues that can be used to settle grievances, like payout to people that have been affected. Is that a fair way to say it then?
yep.
So yeah, I think that there's definitely opportunities to tokenize even that, depending on who's like the person issuing the bond. But if it strikes me from first blush that it's got the same principles as everything else. It's a contract that specifies the quantity of the bond, the amount of the bond, and what the rules are and the exceptions and who's issuing, who's responsible, and who's administering it. So I think that can be applied as well. And then that surety bond, let's say, can be held by the trustee or held by the beneficiaries, and they can prove they have it, they prove the counterparty to it, and they know what it's about. And then when the arbitrator goes in, it's super clear about what's happening in sort of a more digital, insightful way. That's my first blush. I'd have to dive into the details of it a little bit more before I can really comment. But it sounds like, in terms of pattern, very similar to a lot of the other things that we're working on, and very easily incorporatable.